Welcome to the Asureology Show, a growth hacker's guide to human capital management with your host, Mike Vannoy. Each week, we bring you experts in human resources, employment law, accounting, benefits planning, and more to build productive organizations. You'll gain practical guidance for your business. You'll be alerted to the latest news and mega trends that impact small and mid-sized companies. We'll give you the hands-on information you need to stay compliant with ever-changing employment laws, the strategies you need to win the war for talent, and much more, so you can focus on what you do best, growing your business. Enjoy the show.
ACA penalties have increased. Everything you need to know about the Affordable Care Act in 2023. Hi, my name is Mike Vannoy, Vice President of Marketing at Asure, and have a great guest today. If you're a regular watcher of the show, you know Brian. Brian Shenker is an attorney at the Long Island, New York office of Jackson Lewis. Brian's practice focuses on representing employers in a wide range of workplace matters, as well as preventative advice and counseling. Brian has extensive experience defending class and collective action lawsuits under federal and state wage and hour laws. He has successfully defended wage and hour audits conducted by the U.S. and New York State Departments of Labor, and Brian regularly handles cases before courts and administrative agencies involving claims of discrimination, sexual harassment, and retaliation. Welcome back to the show, Brian.
Thanks for having me, Mike.
All right, so ACA, the Affordable Care Act, this has been in place, I guess we're going on, about 8 years now, 2008. President Obama, this is probably his most well-known piece of legislation that he got through. So not a whole heck of a lot has changed, I'd say, in the last year. There have been some Supreme Court rulings along the way that have made some fundamentally impacted the law in the last 8 years. But for the last year, not too much until now. 2023 changes to the penalties for noncompliance. First of all, do I have that right?
Yeah, absolutely. So, right, since the legislation was signed into law, right, it's kind of changed a bit over the years based on, various decisions, right? We saw the individual mandate go by the wayside, but, as ACA stands, right, we still have the employer mandate, and we have shared responsibility. And like you mentioned, we have increase in penalties this year as well.
So before we jump into the specific penalty, just so everybody understands it, let's maybe take a step back and let's unpack what is ACA. I'll do the easy part. It stands for the Affordable Care Act. But you take the rest here, Brian. What is the Affordable Care Act? Who does it apply to? How must employers comply? Really everything a small business owner or small business manager needs to know.
Sure. So, right, the Affordable Care Act really was, as we discussed, the healthcare reform law, and it addresses health insurance coverage, costs, and such. And it really, what is the big item that we'll be discussing today, and there are many parts of it, is the employer mandate, right? So, it's almost mistermed, right? Because the ACA, it doesn't require businesses to provide health benefits to their workers. However, certain businesses, those with over 50 full-time employees or equivalents, and we'll get into all of that in a bit. But those larger employers can face certain tax penalties if they don't provide compliant health coverage that meets certain standards. So that is really the meat and potatoes of what we're getting into today. And, it's often termed the shared responsibility rules, or, the pay to play, right? Those are other words, other terms for the employer mandate. And, these rules, ACA is really designed to promote the employer's traditional role in providing healthcare, access to healthcare insurance. And so, there are a number of, key elements that we'll hit on today, right? The standards for, minimum essential coverage and the mandate, as I discussed. There's certain filing requirements we'll get into. And again, there are, but again, let's take a step back, right? It's not just large employers. There are, requirements and, certain things that are required of, smaller employers, especially if they choose to provide, health
Right.
insurance coverage to their
Right.
employees.
And maybe I think it always helps to understand the why, right? So again, we do our very best to stay apolitical in the show. So I'm not interested in whether you love this law or hate this law. There's obviously a spirited debate 8 years ago when this became law. And some subsequent Supreme Court ruling, but the purpose behind the law is in the name. It's the Affordable Care Act. I think it's fair to say the intent, whether maybe mixed reviews on success, the intent of the law was to bend the cost curve, right? Part of the problem with healthcare costs, certainly at the time, spiraling out of control, is the uninsured and the burden of the smallest employers who maybe were on the brink of whether they could afford to provide health benefits to their employees, and these uninsured people showing up at emergency rooms, and we're all paying for this anyway. And so therefore the Affordable Care Act, and it's much more complex than that. I'm oversimplifying, but really an attempt to include more people, leave fewer people uncovered, and therefore get ahead of the cost curve, things like prevention with good health insurance instead of just reacting to expensive emergencies. So I think the reason I want to talk about that is because everything we talk here around compliance requirements, it really kind of backs into that intent. So again, whether it succeeds in that purpose or not is a different topic. We're not even exploring that, but we want all business owners to understand what the law requires of them. In areas where it may get nuanced, it's always important to step back and understand the why. And the why is to bend the cost curve and reduce the overall cost of healthcare. Brian, what would you add or take away from that?
Yeah, no, I think you're spot on with that, Mike. And right, that's why the various requirements of right providing, as you said, affordable coverage that doesn't exceed certain cost levels to the employees is one of the touchstones of this law. And the failure of an employer to do that under certain circumstances can result in in penalties or taxes to the employer. And so, that's what this is designed to do, right? And as an employer, what you want to avoid is, not offering that type of sufficient coverage and having an employee then get, a subsidy from the government, which, can then trigger, penalties from the employer. And that's all because of, we're looking at the cost, we're looking at the scope of the coverage. And yeah, that's, the shared responsibility element is what brings this onto employers and requires compliance to avoid the penalties.
So there's layers of here. So let's start with just the highest level. Which employers need to comply with this law?
Sure. So the majority of the Act's requirements apply to businesses with 50 or more full-time employees or full-time equivalents. Right. So if you're a company with less than 50 full-time employees or equivalents, then you may still have some requirements, but you know, a lot of what we'll discuss today is for those with 50 or more. And again, we'll get into how you count those because that is significant. To make sure, number one, that your organization knows whether it's what's called applicable large employer, an ALE, right? Those with 50 or more full-time employees or equivalents. Under the mandate, under the employer mandate, these large employers must offer affordable health coverage to employees, and the insurance must provide minimum value to the employees and their dependents. So if the employer doesn't, it may be subject to penalties. And so again, the first question is then determining, are you one of these
Yeah.
ALEs, and So that's the threshold question here for businesses.
So let's start there. I got a bunch of questions. You're an attorney, and you provided some very lawyerly sounding words, as in affordable and minimum value, that we're going to have to explore. Uh, but first, let's get an assessment on the 50 employee mark. So, and I'm just going to kind of brain dump things I think we need to understand. Um, Full-time equivalency. So how do you calculate your part-timers, and how do you account for seasonality? Right. So maybe they're full-time, but only part of the year. How does the formula work for calculating 50 full-time equivalents?
Yeah, great question. Exactly where we want to start. And really for the majority of organizations, the calculation is, fairly straightforward. First, you start with your full-time employees, right? So these are defined as individuals who are working at least an average of 30 hours a month, and you count up all of your organization's full-time employees. And then right now we need the full-time equivalents. So that can be, that's a little more complicated, but it's not necessarily rocket science. So to calculate the full-time equivalents, we add up the total hours worked by part-time employees in a given month with a cap at 120 hours for each employee. And then we divide that total number of hours worked by those part-time employees by 120. And whatever number that comes out to, that gives you your full-time equivalents. And then you are adding your full-time employees and your full-time equivalents for all 12 months, right? And we're looking at the prior year in this calculation. And so you do that. It's basically a monthly. You're going to have the number of full-timers and full-time equivalents on a monthly basis. And basically, any company with a monthly average of 50 or more employees or full-time equivalents in the previous calendar year is considered an applicable large employer. Now, as you mentioned, right, there can be complications to this, right? There can be exceptions to the rule, and for instance, right, those with seasonal workers. So employers who have more than 50 full-time employees for only 120 days or fewer during the calendar year may not be these applicable large employers, provided that 50 of those workers, as long as, those in excess of 50, were seasonal workers. So for those companies with, a seasonal workforce, that's something to certainly take note of. And, certainly you want to look into that exception a bit more. Don't necessarily assume you're, an applicable large employer. It's possible, you could be, you fall below that. On the other hand, I think there are some employers that might think they fall below it, but not. And what I'm talking about is really common, these control groups. So,
Right.
companies that are within the same control group. So these would be, affiliated entities where there's, common ownership, subsidiaries and parent companies. We're not going to get into, all the regulations on this, but, companies should, you should have the understanding that if your company is related in some way to other companies, you should understand whether you fall into a control group, because in that case, it's going to aggregate the employees of the various control group members.
Right. I don't want to go too deep down a rabbit hole necessarily, but is it essentially the same ownership aggregation rules that we would use, say, in ERTC, employee retention tax credits, that if you own more than 51% of this entity and this entity, then you, from the IRS perspective, it's one company.
Yeah, they're going to be quite similar to that. Yes.
So
So you're right. Yeah.
So I think this is an area where I see entrepreneurs of small and growing businesses get themselves in trouble. So maybe I'm assuming this is These are IRS regulations that determine the exact formulas for ownership aggregation. Is that fair?
Yes, that's right. That's right.
But
Uh,
rough general rule of thumb, if you're an owner of business, you're a majority owner of a business, and you've got location number one, you've opened the St. Louis office, you've had success, and you got 25 employees. You open the Chicago office with another 25 employees. You open the Denver office with another 25 employees. Chances are the way the law is going to see you is as a 75 employee company, not three separate small 25 employee companies. Generally speaking, obviously there's nuance, but that's the way we should be thinking about this, right?
yes, yeah, exactly. And I think what people should also understand is these could be unrelated businesses, right? If you,
Well said.
let's take a very simple example. You as an individual are the owner of two different companies. One is a restaurant, the other sells widgets, right? Though it doesn't matter how separate they are, that they do different things. If they're in the same control group, they're going, the employees will be aggregated. So,
Sure.
don't think because, it's a different line of business that it won't necessarily be counted. That's not really a factor in it.
And if we take people back to what is the intent of the law? The intent of the law is to bend the cost curve and not to penalize truly small employers under 50 employees. But if you are a person, the assumption, good or bad, is that you have the financial wherewithal of being an owner of multiple businesses. You probably have the financial wherewithal to participate in this providing of health insurance to employees. So I think that's an important nuance.
Yeah. And I think one last point on this, and I have to say it given my wage and hour background, is that look, many companies not employ, have independent contractors working for them. And imagine this scenario. You have 20 independent contractors and 35 full-time employees. Now you're thinking, okay, I'm not a large employer, but are those independent contractors classified correctly? Right. So misclassification of employees as independent contractors can be a real potential minefield for companies, right? Because that would then potentially increase them above the threshold to
That's
trigger
right.
ACA's large employer requirements. So for companies that have a large number uh, of independent contractors, or at least enough that if they were misclassified, it could push them over the 50 figure. It's you'd be well guided to double check and evaluate whether those truly are independent contractors.
Let's spend some more time there because I think that's probably one of the biggest areas, one of the next biggest areas that employers get themselves in trouble. And I think it's two things. Number one is, oh, this only applies to full-time employees. I'll just keep and there's this thought of, okay, greater than 30 hours. If it, unpacking the math that you shared earlier, 120 hours a month is essentially 30 hours a week, right?
Right.
So I'll just keep my people at 28, 29 hours a week, and therefore I don't have to pay insurance. You know,
Right.
dispel that one for us, please, because that's something people get in trouble very regularly.
Right. And so look, it's going to uh, come back to bite you potentially, right? So if you're keeping employees under that, 130 in a month, I mean, look, if you're very close, that could be an issue too, whether they're actually going over it. But
Right.
again, those individuals will still count as full-time equivalents for the purposes of calculating, whether the company is a large employer. So, again, just decreasing hours doesn't necessarily, avoid the issue here. And again, right, there are costs certainly involved in, providing health insurance under ACA. But again, is it worth it to, set your workforce, set your schedules to avoid this? Right, that probably will have impact actual operations.
Yeah.
Not to mention, look, there are some very good reasons why small employers, those under 50, would still want to offer health insurance, right? So just because you're not a large employer, doesn't mean, hey, we're never going to offer insurance, right? You can attract, better talent potentially, stand out against competition, obviously, potentially have a healthier workforce. There are potential, tax savings for companies that offer insurance. So, there are a lot of good reasons to offer insurance and not necessarily try to avoid the requirements of ACA.
So, and I want to come back to that because I think that's really important. I think market forces are going to be the biggest driver to employers providing health coverage, regardless of what the law says. Starting, I'd say now, call it maybe a year ago, going forward. That said, so there's two scenarios I want to talk about that people get in trouble. Number one is, I'll just pay them less. I'll just have them work fewer than 30 hours. And they can still get themselves in trouble, as you noted. The other is, I'm going to come back to this 1099. Oh, these are just contractors. It's possible for that to be true. You and I have had conversations. Mary Simmons has been a guest on the show. We've talked about this. This is another one of those, call it top 10 areas employers get themselves in trouble is, I'll just make you a 1099. But there's clear litmus tests available on what does or doesn't qualify for a 1099. And if the reason you're putting them on a 1099 instead of a W-2 employee is to avoid the tax, you're almost certainly breaking the law, right? There are very clear guidelines. We don't have to go to all of them, but there are very clear guidelines of what does and doesn't qualify as a 1099 can't even call it employee. It's not. There's no such thing as a 1099 employee. There are 1099 contractors. There are W-2 employees. Without turning this into a show about 1099 qualifications, what would be just your quick hit list for employers to be on the lookout for here, Brian?
Right. So there are so many factors that these tests look at, but what I often say is look at control. Right? Is the company controlling this individual or are they controlling it? Right? Who's controlling how the job gets done? So another thing besides control would be, the length of the engagement, right? If you have independent contractors that have worked for years and it's more or less a permanent position, that could be a potential problem. And then I think, another, kind of thing to think about is, is this, is whatever you're doing, the main part of your business, right? The money making part of your business, are the independent contractors involved in that? If they are, that might tell you that, they might be employees and, if they're really engaged in the heart of your business. That is not a tried and true test, but, I think those are some things to look at. And again, one other thing that I'd say at a higher level would be, does the independent contractor have the opportunity for, profit or loss, right? If you're paying them a salary, probably not an independent contractor. If they're using their own equipment and they might, sometimes, lose money on a job versus make it, that's the indication of an independent contractor.
Yeah. An example I like to share is if you were going to hire somebody to remodel your kitchen, they're probably within reason. They may have to conform within the general timeline, but time of day is up to them. They provide their own tools. They're going to determine the methods of the construction work. If you are providing their tools, telling them when they have to be there, telling them the exact methods and processes to follow, that really doesn't happen. We're used to hiring contractors to redo our kitchen, but white collar work is the same thing. If you're providing the laptop, you're telling them the way in which they perform their job, when and where they perform that job. That ain't no 1099. You're breaking the law there.
Absolutely.
Yeah. Okay. So we talked about the full-time equivalency test. We talked about part-time and seasonality. We talked about the whole 1099 issue where people get themselves in trouble. Let's jump to the topic, the title here. What are the increases in penalties for non-compliance?
Sure. So stepping back for a sec, right there, we can broadly say there are two types of penalties under ACA, right? So first, there are the penalties under Section 4980H, which those ones enforce ACA's requirements for minimum essential coverage, and we'll discuss there are two sets of penalties within there. And then second, there are the separate penalties under Section 6056 of the IRC, the Internal Revenue Code, for violations of the filing requirements, like the reporting requirements to the IRS. And so certainly, both are applicable. Some are more serious than others. And so, if we start out with the 4980H penalties, so under subsection A, employers are subject to penalties if they fail to offer 95% of their full-time employees a chance to enroll in minimum essential coverage, or if a single employee qualifies for the premium tax credit or subsidy. And so under Section A, this is the big one, right? This is a big one. So here it's now a $240 per month penalty per employee. And so that's $2,880 per year. And again, that's per employee. So this is triggered if the company fails to offer minimum essential coverage to 90% of its full-time employees. Right. So that penalty, again, it can, I'll give a quick example, right? So let's say your organization has 100 employees and it has just one single employee receive the premium tax credit, right? Because they weren't offered sufficient coverage. Now you're going to be charged against your entire employee account. And so, again, there's a provision that says you subtract 30 off the top. So basically, you'd have that $2,880 penalty multiplied by 70 employees, 70 out of the 100, because you get the 30 off the top. That's over a $200,000 penalty because one employee received, the premium tax credit. So that is significant. It's applied on a per capita basis for every full-time employee without regard as to whether each individual employee was offered coverage. So again, it's not necessarily a full year, right? This can be a penalty that's applied on a monthly basis if there's any month when this is triggered. But again, it can be a very significant penalty. Penalty B, right, which is subsection B of Section 4980. Now that provides a $360 per month penalty, or $4,320 annually per employee, and that's up about almost $20 from last year. Previously, it was $343 per month. Now, this penalty B will be imposed if an employer fails to offer all full-time employees coverage that meets the affordability and minimum value thresholds. Again, we're going to get to that in a bit, what those affordability and minimum value mean. But again, this penalty is not as significant. It's significant, but it's not as it doesn't come down as hard as employers as this penalty A, because this is only assessed per employee, not for the whole workforce. So, a company that say they have 15 full-time employees, obviously they must have a lot of full-time equivalents to hit the 50 mark. Let's say they have 15 employees, full-timers, and 10 of them, they receive a penalty for 10 of them for 6 months, right? So again, it doesn't have to be the whole year, and it's not going to be necessarily for all employees. So in that situation, we're talking about 360 times the 10 employees times the 6 months, and it's maybe a $20,000 to $25,000 penalty. Mm-hmm. Now again, this is less substantial because the company has already offered coverage to 95% of its workforce. So it's done the big lifting, but this penalty is a result of coverage not necessarily being affordable or meeting minimum value for certain employees.
Let's go there then. Let's define what those two very lawyerly terms actually mean, and how should employers be thinking about them?
Absolutely. So affordable coverage, right? So, this is, as we've discussed, you've heard the name, everyone is hearing the word affordable many times. So for this test, right, to see if it's affordable coverage, you're looking at the employee's cost of enrolling in the least expensive coverage offered by the company that provides minimum value. So even if the employee selects a more expensive plan, doesn't matter. There just needs to be at least one offering of a plan that is quote unquote affordable. Now, obviously, what does that mean?
Yeah.
So there's an affordability threshold that the IRS updates for each year. And so right now, I'll tell you, it's 9.12%. That doesn't mean much by itself, right? What does that mean? So that means the employee contributions for an employee coverage only plan should not exceed 9.12% of the employee's household income.
Okay.
Okay. Now, I'm sure, Mike, what you're about to ask me is how in the world, as an employer, do I know what my employee's household income is?
Right.
And you'd be exactly right that an employer can't know that. So what ACA does is it sets forth several safe harbors, right? So there are 3 safe harbors that ACA provides, and the employer can generally select one of those. It's typically you select one, you stay with it for the year. Potentially, you could have different classifications subject to different safe harbors. But let's just go through those 3 safe harbors real quickly. And I will note that these are important because the safe harbor that an employer selects will dictate how much the employer might have to pay for insurance, because the safe harbor will dictate the maximum amount that the employee can pay towards their health insurance. So then obviously, as a company, you are paying the remainder of that. So the first safe harbor is the federal poverty level. So what we do, we use the annual federal poverty line, and which I believe this year is 14,000 and change. And we multiply that by the affordability threshold this year, which is 9.12%. And that gives you, I think it's a little over $1,300 annually, or about $110 per month under that safe harbor.
So basically, the safe harbor gives benefit of the doubt that, hey, this has to be affordable to essentially down to the poverty line.
Right. So in that scenario, you could not require an employee to pay a premium of more than $110 per month. The employer would have to pick up any amount beyond that. And typically, this federal poverty level safe harbor is going to be the most conservative, right? As the employer, you're probably going to end up paying the most under this, because it's going to set the employee's affordability threshold lower. So then the second one you could use is the rate of pay safe harbor. Quite as it sounds like, you're basing off the rate of pay for employees, whether for an hourly employee it's their hourly rate, or a monthly salary for a salaried exempt employee. And so for these employees, right, the premium that they pay can be no more than 9.12% of their monthly rate of pay, which is calculated by taking their hourly rate and multiplying that by 130 hours. So an example here, I think that'll help. Let's say you have an employee earning $15 an hour. So you'd multiply that by 130 hours, which gives you, I think, $1,900, a little over $1,900 dollars, and then you multiply that figure by the 9.12%, which I believe I did this calculation earlier. I believe it's about $177. So under this safe harbor, and an employee could be required to pay a premium of 177, right? And that's significantly more than 110. So, in this scenario, you'd be looking at, the rate of pay safe harbor is more advantageous for our company. Again, then the last one that you can use is the W-2 safe harbor. You're looking at box 1 on a W-2 form, and basically from there you're taking 9.12% of the year's wages. Now, keep in mind, I believe box 1 is the income reduced by pre-tax deductions like a 401k and other things like that. But again, let's use an example. So we have an employee who makes, say, $32,000 a year. Doesn't matter whether that's at a salary or an hourly rate, right? That's what box 1 says. And then we multiply that by 9.12%. And because that's the annual salary, then we're dividing it by 12 months. So I believe in the 32,000 salary or wage level, that would come out to about $240 per month. So in that scenario, right, you're looking at even higher amount that the company could charge, have the employees pay as their premium.
Yeah.
Right. So these are things that as a company, you want to look into which safe harbor is going to be most advantageous. And like I said, you don't need to use the same safe harbor for all employees. You could do one for salaried, one for hourly employees. You can separate, draw the line based on job classifications, or if you have employees in different states, you can apply different safe harbors to employees in different states. But I think the key here is that the company looks into this because the amount that you can charge employees for their premium, which then results in the company either paying more or less of the health insurance, is a direct result of which safe harbor the company uses. So, very important to figure that out. These calculations aren't too complex. So, and again, it's often backwards looking, right? So when you're talking about the W-2, right, you're obviously looking at, the W-2 for the previous year. So these are things that a company can calculate to figure out, which will give them the best benefit.
That was a question I forgot to ask you, and I think you just answered, but you're regarding a safe harbor. For the full-time equivalency test, you said that's prior year. That's not trailing 12 months, that's the prior tax year, right?
Right. The prior tax year.
Yeah. Okay. Okay, so you got your different safe harbors. If I'm an entrepreneur listening to this, I run a landscaping company. I've got 5 crews, and I'm kicking, scratching, clawing, working my tail off here. I understand conceptually I might need to provide. So I believe I qualify as an ALE, applicable large employer. That I must comply with the ACA. But everything you just read aloud for the last 10 minutes is, holy cow, that's complex. How will I ever remember this? Is it fair to say that you need the determination whether you must comply or not based on an HR or an attorney's expertise, but the actual qualifying plans are largely facilitated through the consultation of an insurance broker?
Right. They are. So, brokers may be able to help you, figure some of these things out. But again, relying on a broker alone, right. Again, our whole discussion of independent contractors, right? So, a broker might only look so far, right? Whereas you talk to an HR professional or an attorney, and they might help you identify certain things that a broker might not either know about or just get into with the employer. So it's important to have this understanding so that if you're speaking to a broker, what questions to even ask. Right, you want to understand what you're offering and how you're complying, and if there are less expensive ways to comply with the law. And so, I think that's very important because, compliance with ACA is not really, as you see, one size fits all.
Yeah.
There are a variety of options that you have as an employer in compliance, and many of them dictate, how much you're going to pay or whether you're going to have penalties.
Right.
Um,
And I go there, Brian, because I think it's important for anybody watching, listening to this show, live or on demand, that the real you must comply with all of it. But the really important thing to understand as an employer is, uh, are you required to comply by the law? Uh, because there's lots of resources to help you. Pretty tough. I think it's important to have a general understanding. So if you're 60 full-time employees, you clearly must comply with ACA. I think everything Brian's talking about are on the different safe harbors and this plan for this group, this plan for that group, based on geographies, exempt, non-exempt. There's a lot of things you can do. I wouldn't encourage you to simply outsource everything to your broker. It's important to understand the requirements of your business, but the fulfillment part, there's help out there in the marketplace. You don't go direct to Blue Cross Blue Shield. You work through a broker who they work with Blue Cross Blue Shield. I feel like the world of insurance brokers has really shifted. There was a pre-ACA, I'd call it the wild, wild west, where, great benefit brokers were truly consultants trying to help you put together benefit plans to recruit and retain people in a cost-effective way. But there's also some gamesmanship around, commission products and whatnot. I think the ACA has homogenized what they must offer because they must offer ACA compliant plans. Is that how you see it as well?
Yeah, and you make a great point. And so this, I think, is a great segue to the other requirement, right? So we were talking about affordability, and ACA also requires companies or ALEs to provide a plan with minimum value, right? So again, what's minimum value? It's basically a standard for measuring the insurance plans to make sure it provides at least the minimum amount of coverage that ACA requires. So I believe it's something around 60% of total allowed cost of benefits. This means very little to both me as well as probably anyone listening to this, right? How would you determine that? And that's because, right, there are standards, and these are things that brokers can push you towards because for instance, the metallic plans, right? The metallic tiers, bronze, silver, gold, and platinum, right? All of those meet the minimum value, plan standard, right? So these are things that as an employer, do you necessarily need to understand the extent of minimum value, or just be aware that it's a requirement and make sure when you speak to your broker, hey, can we confirm, right, that we're offering a metallic tier that offers, minimum value, right?
Yeah.
So that you're meeting those, and there are safe harbors for minimum value. I won't get into those because again, here, with minimum value, you're often going to be relying more on the broker, right? But it is your requirement. So you need to ensure that you are offering that plan that provides minimum value.
Yeah. So I think our guidance here is, we could get deep in the weeds, but the reality is penalty area number one is failure to offer, right? And so you got to determine your criteria, whether you must offer or not. Then if you do offer, does it meet the minimum thresholds of cost and value. And to that, I would say, entrepreneur friends, you don't have to memorize these things, but do make your broker prove to you that the plans you choose are that they qualify, right? That they conform to the ACA for those two buckets of affordability and value. Because certainly, if they can't, then you're with the wrong broker, right? Because that's a fairly standard thing. But those are the two buckets that you need to have them show you that yes, I'm now complying with the law here. Other yeah. Go ahead, Brian. What else would you want to say around compliance? We talked about the types of businesses, the sizes of businesses that must comply. We talked about the rules of compliance. We talked about the penalties of non-compliance. One of the things I wonder is maybe I'm a 40-person FTE company, and I choose to, whether it's the goodness of my heart or I see that I'm required to just simply attract and retain talent. Can a non ALE, applicable large employer, so I'm a 40 employees, can I choose to offer whatever plan I want? Or if I choose to offer a health plan, must it also comply with ACA?
Right. So if you're not an ALE, right, so you should still be providing, at least one plan that, provides, affordability and, that and minimum value. But, unlike for the ALEs, the, applicable large employers, these penalties are not necessarily, you won't necessarily be subject to these penalties. That said, there are requirements for that would apply to small employers, both that offer health insurance and that don't, because there are reporting requirements under the under ACA, and so these include Form 1095C, which which requires disclosure of certain health coverage, offers to full-time employees of health coverage, right? You need to report that. There are deadlines for filing that, right? So, most employers, I believe now, I think that was a change this year, most employers will file electronically, even if you're not required to file these forms electronically. It's advantageous. You have a later filing deadline. And making mistakes on these filings, whether you're a large employer or a small one that offers insurance, can result in penalties. But the general deadlines, I believe, are the filing deadline, I believe, was February 28th. And there's also, I think, a later, March 31st deadline if filing it electronically. So you get, an additional month for filing electronically. So there are those requirements for filings, and there are, there are notices. As with most things we deal with, Mike, there are some required notices. And failure to provide those can result in penalties. So, for instance, and this again, this can apply to an ALE, a large employer, or if you're a smaller one that is offering coverage, you're likewise going to be required to provide these notices. So, for instance, the summary of benefits coverage, right? So that is, that basically provides standard information to employees of what information, about their plan, right? What it offers, things like that. And it's offered when they enroll for the first time or at the beginning of each new plan year. And again, as we discussed, right, there are other people, other companies that you're working with when you're offering health insurance. And so oftentimes it's the insurance carrier that provides the summary of benefits coverage, right? And so again, as the employer, you're still responsible for this. So even if the insurance carrier, is required to provide it, which they are, but they don't, they're not the only ones on the hook. You as the employer are on the hook.
Right.
So it's good to understand, all right, I need to did we did we send this out to our employees this year, or when this new employee enrolled, and penalties for failure to provide, for instance, that summary of benefits coverage is over $1,200 per failure. So there are significant penalties for notice. There are other ones, right? If during the plan year there's a material modification to the plan, we won't get into exactly what that is, but um, it's something that impacts it significantly over the plan year, and you need to provide notice of that, and it can be $110 per day penalty for failing to provide that. So again, employers of all sizes also, have to are supposed to report, healthcare costs if they meet a certain threshold of number of W-2s they issued. There are other fees that they may be required to pay, or even small and large employers might receive the certain rebates under ACA, and depending on the rebate, it might be something that the company needs to distribute to enrollees, right? Their employees. And again, I don't want to get into ERISA right now, but under ERISA, if the company holds on to that rebate for more than 90 days, it should technically be going into some type of separate fund. So again, as soon as whether or not you're an ALE, you need to have an understanding of what ACA requires. And Mike, I think we've both said that brokers are great resources and they will be able to help, but it's not necessarily a one-stop shop. And again, with any statute that is going to penalize an employer, you don't just want to rely on outside help. You want to have some understanding too, especially here where you have options in how to comply. You want to understand, what the best answers are for your particular business.
Yeah. So I think probably what I want entrepreneurs, small business owners on this call to really think about is, okay, we started the conversation around which businesses are required to comply with ACA, and don't think that just because I'm not required to comply, if I choose to, and I want to explore this in a minute because I think this is going to be an increasing trend, if I choose to offer health benefits for whatever reason, I still must comply with reporting and filing requirements. So I may not be on the hook for my $240 per month per employee kind of penalties for not offering. But there are still reporting requirements because you are providing healthcare to your employees, and you got to track and report on all this stuff. So if you choose, you're not required to, but you choose to provide health coverage to your employees, you're not off the hook for all things ACA. You still have reporting requirements, right?
Right, exactly. And we will mention I know we typically focus on our federal requirements, but just so it's known, various states still require certain filings in those jurisdictions. I think many have gotten rid of it, but I believe California, New Jersey, Washington, D.C., to name a few, still require employers to report, various information, health insurance information. So again, the IRS isn't necessarily the only, place you're looking in terms of, filing requirements.
I think maybe the last topic I want to explore, Brian, and I'll ask you to step out of the role of lawyer and into labor futurist, if you will. Here's my thinking on this. The role of HR in small businesses. there's obviously a compliance component. So Brian threw a whole bunch of stuff at you today, things that are required of you, not required of you, depends on this rule versus that rule, seasonality, full time versus whatever. There's a lot to it. It's complex. And so there's an HR role around staying compliant with an everly increasingly framework of laws, federal, state, and local. All that said, if I go back to the intent of this law was to help bend the cost curve and not put that such an incredible burden on employees, right? So this is in my mind, this is part of a continuum that is a shift from from the employer to the employee. And it doesn't matter whether you lean left or lean right. If you look at legislation passed from both blue and red White Houses over the last 90 years, the continuum is clear. This power shift is happening and will continue to happen. Combine that with what is, I believe, a now nearly permanent labor shortage. We can blame wars and pandemics in presidential politics on unemployment rates, but the reality is it's much more determinant on what is gross domestic product and what is the productivity per employee over time, and birth rates from 30, 40, 50 years ago. And the bottom line is boomers are retiring. Birth rates have been lower for 40 years. We're kind of at this level. There's unemployment is, 3.6% in the June jobs report. There's millions more openings than there are workers. Now, there's maybe mismatch in the types of openings versus skills of workers. So there's a lot of nuance here. But I'm of the belief that this labor shortage is a permanent structure for at least the next few decades. And that as an employer, whether you do or don't, whether you must or must not comply with ACA based on how big you are, I think this is something that employers are going to have to take a serious look at, because increasingly employees have choices and they're going to vote with their feet. And if they can, a lot of them will want to work for a small business, but they're going to come with expectations of big company benefits. And so it's maybe more of an encouragement from me to employers to don't think about this through the lens of what does the law require of me, and I'm going to do the minimum required, not because I'm a bad person, but because I'm trying to run a business, and running a business is hard, and I need to squeeze every penny out I can of this thing. I think the biggest challenge for employers, call it the next 20, 30 years, is attracting talent. I'll get off my soapbox, but you bring us home. What are your thoughts on this topic, and how does it how it relates to employers and how they should be thinking about healthcare?
Yeah, I absolutely agree with you, Mike. And I would put this in the basket of other laws that we've probably seen more at the state and local levels
Yeah.
that have even though they might add requirements for small employers, they make them more competitive, right? For instance, in New York, we've had paid family leave, or New York City and New York State, paid sick time. These various things that look, as an employer, you can look at it one of two ways, right? Oh, an additional requirement for me to comply with, it's going to be more costly, or it's an opportunity, right? Or it's an opportunity to comply with this and be more competitive, right? Complying with it, you're going to offer similar benefits as a potentially larger employer might. And so, yeah, I think with the job market as it is, and I don't necessarily disagree that with you in terms of whether it's going to change or not. I think it may be like this for a while. Companies need to think about these competing pulls, right? Do I save $1 now, or is it an investment in a more stable and more talented workforce that will pay off down the road through the talent and better work for workers, efficiency, and all that? Not to mention building a better culture
Yeah.
within organizations. So, right, I think looking at these things as opportunities. And then, of course, you need to ensure compliance. But it absolutely is a potential for companies to offer something that can, put them in higher demand, with employees.
Yeah, very good. Brian, always enjoy talking to you. I know the title of this was the increased penalties. It was maybe the smallest part we covered, but it was maybe the most important. How about this for a last thing? It's hard if you're an employer. If I drive down this road and I know the speed limit is 55 and I drive 75 on this road every day and I've never seen a cop, I might not be too worried about this thing, right? How is it that these cases even come up in the first place? And maybe I'll pose my hypothesis and have you close with this. In a world where employees have increasing power and healthcare is important to them, and an employee thinks that you're legally obligated to provide them with insurance, whether you are or you're not, increases the likelihood that they're going to complain. And maybe not them, maybe it's their spouse, maybe it's a family member who wants to get on that plan and they complain. That's how these cases all of a sudden blow up. And it's a report to the Department of Labor. It's a report to the IRS. It's a report from a disgruntled employee to an attorney, and all of a sudden action is taken. There's a lot of people flying under their radar that are not compliant, not because they're bad humans, but they just simply don't know. But in this increasingly competitive war for talent, I think it's going to be the disgruntled employee that initiates some action, and that's how employers are going to get stung here. Am I thinking about that right?
Yeah, exactly. And I think here, right, it's, with different statutes, with different laws, it's different employee action. And I think here, that main type of employee complaint, right, it's not necessarily a complaint, but that employee who does not get offered, compliant health insurance, they go and they get a subsidy. And now you as the employer, you're going to be on the hook for some penalties. I think that, in addition to that occurring, I think other common, violations or, areas we see that result in penalties are either, a failure to file something with the IRS because either you may not know you have to, or a late filing, not knowing when it needs to be filed, inaccurate filings, failing to check off certain boxes. Those things too, but absolutely, I think that, with, employees understanding their rights more, if an employee understands that you haven't offered them appropriate coverage and they go and, get a subsidy or, a credit, employees know their rights more than ever these days. And the likelihood of that occurring when, inappropriate coverage is offered to them is probably, becoming more and more likely.
Yeah. As Mary always says, the best way to avoid litigation or fines for noncompliance is to have great, respectful relationships with your employees, because when they respect you, they'll give you a lot of latitude to make things right. So, Brian, always enjoy talking to you. Great conversation today. Hopefully everybody got value. Until next week's show, thanks for joining us.
At Asure, we build human capital management software and services that help 90,000 companies like yours attract, develop, and retain great people. Our low upfront costs and affordable subscription model allow you to save cash to invest in things that drive growth, not overhead. To learn more about how Asure can help you claim up to $26,000 per employee with the Employee Retention Tax Credit, automate your payroll, and build productive teams that are compliant with ever-changing HR laws, visit AsureSoftware.com.